Hey, Quasar Markets Live. You've been asking for him. I brought him here, Scott Bauer, CEO, and my friend of Prosper Trading. Scott Bauer, you are there live in Chicago. You see those traders in the VIX pit. Up 10% today there in the VIX. What's going on in the world, dude?
It is busy. It is busy, and it's no different than a lot of retail traders that maybe come late to the game, right? So the order flow, what's coming into the VIX pit now, all of a sudden there's all this buying, and it's really interesting, Steve, because people that had October positions in the VIX that maybe expire next week or the following week, there's a lot of rolling out. What does that mean? Closing out their October positions, buying November, buying December, buying January, just kind of extending that timeline to have that protection. And so even though we're seeing, some short-term market volatility and gyrations right now, a lot of the paper flow that's coming in is maybe either institutional or retail paper saying, all right, we still want to have that protection. We're just going to push it out a couple months.
So when I hear the word October, here we go.
That's garbage. That's garbage.
Good. I'm glad because I felt the same way. I'm like,
Garbage.
no, I don't think it's going to be October. I think it's going to be Downtober. Or it's going to be Ouchtober. You heard that from several institutional traders telling you that. But tell me, why are we still seeing retail buying the dips on everything, man?
Because that's what the trend is, and the trend is your friend. And regardless of what anybody thinks the long-term outlook is, that's what the technicals are pointing to. And at some point, that trend is going to end. At some point, that trend will break. But the buy the dip has been phenomenal, and it may continue that way. At some point, it's going to break. It really is. But I think what we are seeing, though, is that buy the dip is maybe getting a little bit less than what we saw over the last several months.
Yeah, and you one of the cool things about you, Scott, and I've known you for a long time, and you've had your ear to the ground for 30 plus years in the pits, and you missed it. We were giving hand signals to each other, Peter and I, earlier today. I had my hand signal book behind me. What are the boys saying? What are the guys on the floor? What are they actually saying? The real traders, the ones who put their lives on the line every day, not the Robin Hood.
Right. No, these are the real deal, and these are also traders. You got to remember, Steve, the traders that are still left on the floor in Chicago. It's extremely vibrant in the S&P 500 options pit and the VIX pit. There's 200 traders, right? So these are people that have been down there for a long time. And they say the same things that I say as the trader mindset is: love the volatility, got to always have your bullets, meaning always have your protection, and let's trade them up. I think the overall outlook, if people had, there was a survey out there of these 250 traders, and he said, where's the market going to be in 6 months from now? Some of them might say, or I think the majority of them would say slightly lower. Slightly lower, because I think everyone is expecting something to happen over the next several months. And I'm not talking about a big calamity, but maybe a 5-10% pullback, which would not be out of the ordinary. But, these guys are professionals. And like I always say, you buy when you can and not when you have to. So when the VIX was trading in the mid-teens for months on end, and S&P volatility was 10 or lower, these guys were all loading up on protection.
Right. And I've been asked several times, you and I are both on Schwab and the street and all the fun things. And Carolyn Woods asked me specifically where I thought the market would be here come into December, going into January. And I said, look, I think it's going to be sideways. I think the markets, I think a lot of the ups and the downs, the buy the dip and the sell the rip mentality is starting to fade on both sides. It's more, I think that people are just tired of trading in a lot of ways.
I think it's a great trading environment for you, for me, for the traders on the floor. I think as an investment, I'm not so sure I'd want to be putting new money into the market right now for the next 3 to 6 months. But as a trading vehicle, I mean, this is what we live for. We live for S&Ps moving in a 100-point range daily. I mean,
Yeah.
that just creates opportunity.
Yeah. And when you look at the next level of trading, and I asked this of earlier day of Peter Thomas, you and I have seen the markets from trading from graph paper and pen to computers to
You're that old, not me. I'm just kidding. Actually, you're older.
Oh, okay, Scott. What are we seeing now? What's the future looking like in technology? The future, because I hear AI, and I've been talking about, I've been talking about AI for 15 years, and now here we are. It's AI this and AI that. But is that the future, or are we looking at something else right now?
I still believe, and maybe I'm biased, sure. AI is great, but to get the best bang for your buck, if you can combine knowledge, okay, real trading knowledge, okay, with a feel for what's going on in the environment, along with AI, that is the way to go. And I say that because what AI can do that I can't or you can't is instantaneously giving me all the back data that I want.
Right.
Giving me this scenario, what will happen? This scenario, what will happen? Great. Great. I get that scenario or I get that data, but then I put my trader's cap on and say, okay, in the real trading world, I'm going to use that data, but I'm going to approach it differently. And I'm going to approach it this way. And
Yeah.
that is, to me, that's as close to the optimal situation as you could get right now. And I don't think that's going to change. I really don't see um, the floor trading going away. That's definitely not going away.
No.
But I don't see that having the kind of professional interaction with the computer generation. I don't see that going away, and I think that is the best thing that we have going for us.
Wow, sounds like you have a Quasar Markets an account. I love that. Okay,
Maybe.
let's get to it, Scott. And I know you're not a scared guy, so and I know you can handle it. So let's get to it. Politics. We've got a president who said I can easily fix wars. I can end them. I can fix the and here we are. We are now still in with Ukraine. We're still in with Hamas and Israel. There's all these messes. And over the last few weeks, I keep hearing from other traders going, well, find the positive, Big Beat. Where's the positive? Where you can take a quote, take a dart and throw it in a dark room and hit a bad thing. So, Scott, I'm going to ask you, where's the positive in all this net mess?
So the positive is the hostages were released. Okay, to me, that's a big positive. From an economic standpoint, I'm not sure that we've had any. Prices are not coming down. The employment picture has gotten worse. I'm not saying that's any blame of the administration, just pointing out the reality. Okay. Yes, interest rates are slowly moving down, which is a good thing, but that has no bearing on this administration, last administration, FDR's administration. That has a bearing on just the economic cycle of what is going on right now. So, from what positives I can take out of this, other than, people are going to say, well, the markets are at all-time highs, right? Okay. Is that a reflection of the administration? No. Was it a reflection of the administration during the last administration when markets were at all-time highs? No. Okay.
No.
It's not. I'm not sure, Steve. I'm not sure. That's
okay. Well, let's get
I guess stopping wars. I don't know that we've seen 7, 8, 9, 10, 50, 100 wars stopped. If anything, I think that global relationships, geopolitical risks are as high as ever. At least for us here, I think they're as high as ever. Yeah, that's my take.
All right, I'm going to say this show is sponsored by the letter P. Going back to our old days of PBS and Sesame Street. When I ask the question of a lot of people, Powell, purple tie. Powell says, the world is interesting. He says to me on a monthly basis, 2%, 2%, 2%. It is data dependent. We are going to make our rate decisions on data dependence. There's no more data. We're now hearing a lot of the governors saying, hey, we don't know what to do. We have no data. What do they do, Scott?
Yeah, so it's funny, Steve, and you and I are both alums. It's a great thing. I actually helped teach a finance class at University of Illinois.
ILL.
I think I have this here. And I had that earlier today, and that came up. How does the protracted government shutdown affect the markets? And we're all used to this data. And whether you're a believer that the data is right or wrong is irrelevant. Okay. We're all used to the data. The market's used to the data. The more we don't get the data, whether it's employment, PCE, CPI, PPI, whatever it is, the longer we go without it, okay, the more, the less likely, I should say, the less likely that when we do get those reports, that they're actually going to be reflective of what is happening. So I think that in and of itself creates more volatility for the marketplace. I don't think that is a good thing. Again, you don't have to be a believer that the data points were right or wrong. Okay, true or not. The market does not like uncertainty. And we have, in my opinion, skated over the last couple of weeks with not getting this data. And I'm afraid the longer this goes on, the market's going to catch up to that uncertainty.
Okay.
That is really out there.
So you don't have data. I don't have data. The president doesn't have data. Powell doesn't have data. And we're hearing some people talking about alternative data, that you've seen Bloomberg pushing out alternative data, Wall Street Journal pushing out alternative data. We know that ADP has their jobs, alternative data jobs numbers. What is it that you're turning to that you during this government shutdown, which looks like there's no end in sight? What are you turning to for data to help you make better decisions?
I'm looking at the bond market, and the bond market has always been very telling. And that could be a reflection also of things that we don't know and the uncertainty. We see the 10-year ticking under 4% today for the first time in a long time. And I think that's all driven by the uncertainty that is out there, and perhaps by the thought process that when this data does come out, the data is not going to be good. So I'm looking at the bond market. And other than that, I don't know, what else to make of it. I'm not an economist, but the bond market is pretty darn tried and true.
And first thing I learned 35 years ago was bond traders are the smartest traders. They're the ones that manage the most money, and keep your eye on the bond market. But I look at the bond market. I look at the 10-year. I look over at CNBC and I listen to our boy Rick Santelli talk about it. Last time the 10-year was under 4% back in March of 2024. This is a rough time. When the bond market 10-year goes under 4%, that means money is pushing into it from institutional because they're scared from the stock side.
Yeah, exactly.
How scared are those boys over there in the bond pit?
I don't think they're scared. I think they're looking at this as opportunity as well. The volatility that we're seeing is great, but I think that there's so much uncertainty of the curve, the 520, the 1030, the nature of how we've seen things in the past, duration wise, is still, to quote Jerry Seinfeld, a tad askew. So I think they are a little bit nervous in that regard, but they look at this and say, we're gonna trade this volatility that's there. They're no different than you or I when it comes to trading.
You use that Seinfeld reference. I think I'm gonna talk about the mom and dad of Jerry Seinfeld and the stinky car in Florida. I mean, it feels like that bond car is the stinky car. You just can't get the stink out of it, right? I mean, it just smells bad. Yeah. And as the car is driving, they just can't figure it out. They keep taking the cleaners and it keeps getting cleaned up, but they still can't get it clean. And when I look at the next level of let's just say fourth quarter, and I've brought this up a couple of times. I saw Dan Niles in the Euro Stock Exchange, and Dan said, "Look, it ain't going to be a fun Thanksgiving." Do you agree to that?
Depends what your expectations are. My expectations right now is that if we sell off 5 to 10%, that's not a bad thing. Yeah. I'm not saying I'm looking for that. I'm not saying I'm positioning myself for that. I'm saying that if that's what we got out of this, that's probably not a bad thing. But if people look at that and say, "Oh my God, if we sell off 5 or 10%, we are screwed. We are, then that's a bad thing."
Yep. Okay. Last question. Have you, as your heart healed, has your brain mended since the Cubs lost in the playoffs?
Yeah, it was fine. Actually, I was fine with it. And you know how diehard of a Cubs fan I am, and the rivalry that we had. Because you know what, my expectations, my realistic expectations, just like with trading, were that they weren't going to go real far, that they didn't deserve to go real far. So I actually looked at it as a benefit and maybe something to build on for next year.
Damn it, I was rooting for you guys because I
know.
I was actually rooting for the Cubbies. And everybody knows I'm a Cardinal fan. All right, Scott Bauer, everybody loves you. I'll put it up one more time. Please, for the love of God, follow Scott, SIBO, Option Pros, C. But if you don't know, SIB is Scott's initials. I love the fact that he plays the SIBO. Look behind you. There it is. That is actually his badge. On the floor. I will be seeing you, Scott, in a few weeks, as I will be in Chicago too as well. All right. For all you guys out there in Quasar Marcus land, love you. We'll see you back right back here soon.
Bye, everybody.